Welcome back, dividend growth and value investors. In today's video, I will explain you how I am preparing my dividend growth portfolio for a possible deep recession and why credit ratings are so important to me. Understanding what you own is key to sleep well at night. At the same time, a potential recession might just give us the perfect opportunity to add some of those high quality dividend growth stocks we always wanted to own so much. So guys, this video is fully packed. Let's get started. So guys, if you're doubting about your dividend growth strategy and if it's really the right one to pursue, well, just don't doubt too much, okay? Morningstar did a really nice analysis at the summer of this year, and they have shown here and demonstrated here that generally dividend stocks outperform other stocks during recessions. And you can see that here, right? Because specifically during the dot-com bubble, as an example, and the great financial recession, high dividend stocks just did so much better. Of course, COVID-19 was a little bit of a different situation because during this crisis, Disney, Shell, and some of the other big dividend payers cut their dividend because they didn't know what was upcoming. I consider this rather as an exception to the rule compared to normal recessions, like for instance what we are seeing now with increasing interest rates. And in the article, it goes a bit further, and I will also add the article link to the description of this video below. It also shows you here that focusing on dividend growth is actually the best one during a recession. Hey, and I'm a dividend growth investor, and that shows it here, right? So the max drawdown is minus 24% for dividend growth. If you have a combination of growth and income, it's minus 25%. And if you only focus on income, for instance, high yielding stocks, it's minus 28%. So also from that point of view, dividend growth stocks have been outperforming other dividend income strategies over the last few recessions. Whether a recession coming is something I really don't know. I shared this picture of the S&P 500 on Twitter this week, just asking because it should look like a double bottom, but I am by no means a technical analyst. Luckily, some of my followers are, and what they showed me here is that if we look at it, we should be, kind of worried because anytime soon we will know what's going to happen. Although, on the other end, of course, this might be just the opportunity of the year because we're nearing the bottom, and if it bounces back, we might really make a lot of profit. So honestly, we don't know. He shared also another picture with me where it really resembles the great financial crisis from 2007 and 2008. This looks, of course, way more bearish, but honestly, I really don't know. What I can tell you, if this is really a recession, I always like to go back to the cheat sheet from Wall Street by the psychology of a market cycle. It shows here anxiety, denial, panic. I truly believe we haven't seen panic yet. I don't see people massively selling their portfolios. Yes, there was a little bit in growth stocks, these hype stocks last year, from November last year, September last year until now. I've seen some panic there, but generally in the overall market, I haven't seen it. For me, what is panic? Remember, there was a time during COVID-19 where there were literally no cars in the street. For me, this was really where I saw capitulation in the market, although it was maybe just a week. In 2008, I remember documentaries about, for instance, the harbor in Norway, that there was just no cargo coming in at that time. For me, that was already just after the panic. Occupy Wall Street, all these kinds of things. We are not seeing them yet. So hence, for me, I'm really thinking that we're somewhere around anxiety and denial. So questions like, why am I getting margin calls? This dip is taking longer than expected. This is kind of where I'm feeling that we are right now, looking at the sentiment that I get from reading the news and social media. So having said that, we know now that a good diversified portfolio with dividend growth stocks should fare pretty well during recessions compared to other stocks in the stock market. But what makes it a high quality dividend growth stock? So if I look at my own personal way of assessing this, I look at several elements to really assess also whether the dividend is safe. First, did the company show growth over the last years? That's very important for me, bottom line growth, both in free cash flow and earnings per share. Second one, do they have a healthy balance sheet? Of course, the credit rating is so important here, and I will get back to that later. We look there at debt to equity, interest coverage, specifically in an interest raising environment. You really want to make sure that they can easily deal with it. Any interest coverage below 4 or 5 is something you really should pay attention to during these times. Secondly, can they afford to pay the dividend? Of course, a payout ratio, the lower the better, but at the same time, we also want to see a proper dividend yield, right? So has the company also shown commitment to the dividend? And it's really important for me to see their behavior during the last recession. Were they keeping it flat or increasing? That's really important for me. I don't mind if a company is conservative and keeps the dividend flat. I know you might lose the dividend aristocrat status. I'm okay with that, as long as it's growing the dividend over time. Last but not least, of course, we want them to be in a growing market, not in a stark declining market, because that makes it really difficult. So why is the credit rating then so important for me if we look at the quality of, for instance, a dividend growth stock? Well, actually simple. If you think about a credit rating and what it takes to get a AAA rating, look what it shows here: earnings growth, profit margins, future outlook, regulatory environment, tax burden, industry trends. Honestly, also if we look at the balance sheet here, the financial health, a lot of this is aligned with my dashboard here and how I assess the dividend safety. So, I can save myself a lot of work by just looking at the credit ratings of companies and also assessing what the analyst is writing there, right? Because they give so much valuable information. Okay, so what is a corporate credit rating? Really quickly, it's an opinion of an independent agency regarding the likelihood that a corporation will fully meet its financial obligations as they come due. A company corporate credit rating indicates its relative ability to pay its creditors. So it's really about, can they pay down their debt? That's really what the corporate credit rating is about. And, it does this in all kinds of ratings. So you see the code from AAA. This is the gold standard. It's what we call prime. High grades A1 to A3. Upper medium grade A1 till A3, and then the lower grade medium grade BAA1 and everything related to that till 3. And then actually when we talk about junk, that's already here, we're talking about BA1, BA2, BA3. What's really interesting here, if you look at the long run benchmark, almost no company has gone bankrupt that had a high grade credit rating, 0.1. But if you then go, for instance, to the BAA, to the lower medium grade, it says 1%. And then comes a really big jump to 7.5% chance here. So for me, this really shows you why it's so important to not have companies below a lower medium grade. And even so, I would say anything in BAA3 is already at the border, and you should really assess those companies. Because there's also one big risk with credit rating agencies, and that is objectivity. While they claim to be objective, we have seen during the great financial recession that this objectivity can be considered quite shady. And I think a great example is the Big Short movie. Do you remember this one?
Georgia, can you name one time in the past year where you checked the tape and you didn't give the banks the AAA percentage they wanted?
If we don't give them the ratings, they'll go to Moody's, right down the block. If we don't work with them, they will go to our competitors. Not our fault, simply the way the world works.
So really, that explains you pretty much the risk also with rating agencies, right? So hopefully they have also learned a little bit from that phase. Anyway, we always do our own homework, right? We don't just take everything at face value. We always make our own assessments and our own judgments. We need to do this really to know what we own and to sleep well at night. But also there are some lists around about all the companies with their credit ratings, because it's not easily to find this online. If you go to Seeking Alpha, you will find one, but there's an issue here because, for instance, it only lists 2 AAA companies in the world, Microsoft and Johnson & Johnson. But also Apple became last year a AAA company, and many people don't actually know about this because I hear them all the time forgetting about Apple. But the upgrade of Apple rating reflects the company's exceptional liquidity, robust earnings that we expect to continue to grow over the next 2-3 years, and it's a very strong business profile. So this is actually what you can read up on Moody's, right? So if you create an account on Moody's, which you can do for free, you can actually look up most of their reports, at least when it comes to the changes of credit ratings. So let's take an example here of Johnson & Johnson, right? Johnson & Johnson, if we Google for Moody's, and I really have this free account, you can see here that they have a AAA credit rating and a stable outlook. So the only thing you need to do now is here to go to one of their latest rating actions. You can see that opinions and such are all locked for us as investors. But in this case, Moody's affirms G&G's AA ratings and revises its outlook to stable from negative because it had a negative outlook before. So here we can see the outlook change to stable from negative reflects Johnson & Johnson's ongoing progress at resolving litigation uncertainties. That was also one of the reasons why they got a negative outlook. So that has been fixed, and this is now how I know a little bit more about why Moody's gives Johnson & Johnson a certain credit rating. And if you look at the typical outlay of a report, it has the headline summary, right? Then it shows the rationale behind the ratings. It's typically a one-pager or something like that. And then it always lists the factors that could lead to an upgrade or a downgrade of the ratings. And this one I also really found interesting because effectively they are explaining the rules by which they assess. And with this, we can look back at our own portfolio, of course, and look at the company and assess whether we agree with it, because maybe there are other things that are of our concern when it comes to still the dividend safety. But this is how you can read the typical Moody's reports, and I find them very, very informative when doing my own homework. So knowing all of this, this video is also about sleeping well at night during the upcoming recession. If we get one, right? It seems to so if I get a sense of the market, also if I see the price action, and if I see how our governmental politicians are communicating with us as citizens right now. So this is how you can really analyze the companies using the input from Moody's. But hey, this video is also about sleeping well at night with our portfolio, right? And really understanding the risk in our portfolio, also from a credit rating point of view. So what I've done, I went back to my portfolio, my whole portfolio, looked at all my positions and downloaded the credit ratings. For 90% of the times, Moody's was also the rating agency. In few other times it was S&P Global or Fitch ratings, and in that case I translated it to the current credit rating of Moody's just to stay consistent and for easy analysis. I also added the outlook and what it meant according to the classification of high grade, prime, lower medium grade. So then what I did is I added two charts to my portfolio dashboard, and this became really interesting. So almost 6% is held in portfolio value. So the total sum of my entire portfolio in dollar value or in euro value, let's say 6% AAA, 27% high grade, 45% upper medium grade. So I'm really happy with this. This means that 80% of my portfolio value, and the value I'm talking here about, is invested in really upper medium grade or higher dividend growth stocks, which I'm really happy with. 20%, however, is invested in lower medium grade, and this is really the category that I need to look better at. But now comes the issue. This is not the same from a dividend safety and a dividend income point of view, because if I look at it from a dividend income point of view, my higher yielding stocks tend to be also lower medium grade, and here I've got an exposure of 33.6%. This is a lot. This is 1/3 of my portfolio. Now, it doesn't mean that these companies are bad. This is really important to know because we can't just judge the cover by its book. But what I can do now is looking at, okay, which companies are having a lower grade. So let's look at it, right? If we look at the lower medium grade, we can see here companies like AppFi, which got a positive outlook actually. And why is that? Here again, Moody's, rising sales of Spirit Sea and Rinvoq, coupled with ongoing debt reduction, increase the likelihood that AppFi can absorb Humira biosimilar competition with a stronger credit profile. These factors contribute to the outlook change to positive from stable. And guess what I've been doing over the last 2 years? I've been continuously looking at the debt pay down and the portfolio growth with these two new drugs. So probably it's coincidence, I don't know, but I'm looking at it exactly the same when I'm assessing AppFi because it's one of those balance sheets and the only balance sheet actually in my top 10 portfolio holdings that I'm a little bit concerned about. But at least my thinking here really aligns with Moody's. So then if we look at other stocks, and here's for instance one that I'm really a bit more concerned about is Omega Healthcare. I've got an 11% yield on cost on this one. It has a 2.6% portfolio allocation, but 6.2% is depending on my dividend income from this single stock. And it has an outlook negative, while it has already the lowest lower medium grade credit rating. So why is that? Key credit challenges include a difficult operating climate for Omega operators. There is, for instance, already for quite some time, even before COVID, a shortening length of stay and rising labor cost. The negative outlook reflects risks to Omega's rents and cash flow as its tenants continue to face a very challenging operating environment, while the extent and timing of further government support for S&F operates remain uncertain. On the other hand, a little bit more positive here, leverage is modest and Omega has a long history of managing leverage within its publicly stated target. Longer-term favorable demographic trends with a growing population of seniors will provide support to S&F fundamentals and is credit positive for Omega. Now, this is actually what I fully understand because I've been holding Omega Healthcare now for several years. It has been giving me lots of dividends. It's after Shell, the biggest dividend income payer to my portfolio. I am fully aware of the risk, and I take it. I don't believe that if we will see a dividend cut, that it will be a 100% dividend cut, rather 20 or 30% to adjust to the reality for this company. It would still give me a lot of high yield dividend income and I'm fine with this. Is this a dividend grower? No, it has been really flattening their dividend over the last 2-3 years. So probably also from that point of view, I will underperform dividend growth stocks during a recession. Other than that, I know now what kind of weakness I have here in my portfolio. With Bayer is something similar. The litigations, what I checked, exactly the same. I'm still doubting whether I should hold it or not. There are probably others here. General Electric is just for fun still in my portfolio, small position. And Enagas has also a negative outlook due to political situation in Spain and also what's happening all in the energy market. So this is really the risk that I have in my portfolio. But I'm totally not concerned by a company as Ahold. They can just take so much more debt on because during a recession we keep on eating. It's one of the last things we save money on. Hence, there are definitely some companies here that I'm totally not concerned about whether they can meet their obligations. This is managed on purpose like that, and it's even in the goals of the company to maintain such a credit rating. So overall, I think my portfolio looks actually pretty good. Mainly Omega Healthcare, I'm kind of most negative about myself as well when it comes to the dividend safety and what it means from a credit rating point of view. At the same time, I also manage a watch list in my portfolio tracker. You might know this watch list from also looking at my blog. I have there my portfolio allocation strategies. These are all the stocks that are listed there. These are all the stocks that I want to further accumulate in. So what I have in my watch list is now added the credit ratings. I didn't have that before. And at the same time, I also show you what I'm doing. I have here the current yield of the dividend stock in the watch list, the fair value estimate based on all the videos that I made. That's what you see back here, and then an advice. If it's a consideration, it means one of these two is within the zones that I like it. For instance, a current yield above 3.25%, then it could be considered if it's not reaching fair value estimate yet, and vice versa. So if I now would look, for instance, at all the high quality companies, because that's the opportunity that we're getting with a recession now, which to buy. So let's take only the prime and the high grade, because I don't want to accumulate more Intels at the moment. I've got enough of it. They have enough yield in my portfolio, but these might be the opportunities to really double down on some high grade stocks. And what is interesting here is that if we then also would, for instance, sort it by credit rating, so let's do that here. What you can see here, for instance, and one that really speaks out to me is Allianz. Allianz currently has a 6.4% credit rating here. And if we then go to Moody's and we look up Allianz here, we can look at their latest report where it affirms the rating and changes the outlook to positive. So why did it change the outlook to positive? That's of course the question, but here we see it already. It reflects Allianz's very strong market position and diversified business model, the reduced pressure from low interest rates on the group's life business, very strong earnings, which Moody's expects will withstand pressure from macroeconomic headwinds, as well as Allianz's very strong capitalization. Now look, this is effectively why I'm also bullish on Allianz. It's one of the biggest insurance companies in the world, but very well capitalized. They have been dealing well with the litigation that they got from North America. So I feel this company is pretty attractive. So if we then also go to my dividend stock dashboard where I have assessed Allianz in the past. So let's quickly look up Allianz. What we can see here is that in my opinion, their dividend is safe. Why is it maybe not having the highest score? It's because the growth prospects, I believe that it's a stable stable growth company, not so many clear tailwinds. At the same time, they also kept during the last recession the dividend flat. Having said that, if we look then at the analysis here, and we can see that most of it is all in green. EPS payout is a little bit on the high end. We need to look at net income here for this company, not at free cash flow, because within the free cash flow, you've got also all the policy claims and all of this, which is not relevant to assessing an insurance company. At the moment, it's trading at $168 share price with a dividend yield of 6.4%, 13 years of dividend growth, and 5-year dividend growth rate of 7.28%. If we model this with a 6.6 billion of net income, which is actually relatively conservative if we compare it to the last 7-8 years, at a growth of 6% and 3% thereafter, a discount rate of 10%, I believe the company is worth €257. So in my opinion, this company is heavily undervalued, and I find it very, very attractive right now. But look, this is it from a watch list point of view, right? What I just showed you. This is how I'm analyzing my portfolio. Energy companies, I've got enough of them. I don't need any more here. But we see here L'Oreal, Roche, Munich Re, another insurance company, Texas Instruments, Johnson & Johnson, Microsoft, Apple. But let's take an example of Microsoft. Microsoft, where are you? So we go from Allianz to Microsoft, and Microsoft here has a fair value of $293. I took here 61 billion free cash flow. Trailing 12-month numbers were 72 billion, and I haven't included even the data of the latest annual report. So this is still quite conservative. I took, though, a 20% growth rate in the first 5 years. This might be a little bit less, 12% thereafter, at a discount rate of 12.5%. 18 multiple would give me $300. If we would take like this same number and then a 12% growth rate and 8% thereafter, we would be talking about 180 or 170. So it's trading currently at a 237 at a dividend yield of 1%. This is of course way too low. I would love to see this 2.75 or 3, but then we are really talking about a $70, stock. This is of course really, really unlikely. I treat Microsoft though as such a stable and well-performing company that I would consider it probably during these circumstances of recession somewhere around the $200. Maybe it gets there, maybe not. I don't need to wait because I have enough patience, but this yield is too low for me to just buy it right now. I want to be more greedy. Another company, for instance, that is interesting here is maybe Google, Alphabet, for instance, a non-dividend payer, but also just to show you how it works for other companies. Here I've got a fair value of $93.86, and the current share price is $98. For me, this is also at the moment really an undervalued company. Everything is green, of course, separate from the dividend yields because it's not paying a dividend. But guys, this is where credit ratings really, really matter, because also here, this company has a AA2 credit rating, a premium grade credit rating, and also this is a stock to sleep well at night if you want to consider something else, a dividend growth stock. Now, there's still one company though, before we close out, that I really would like to touch on, and that is Castellum. You've been asking me quite a lot about my opinion on this, because Castellum is one of the lowest medium grades right now, Baa3, but with a stable outlook. So what happened? Castellum was recently, just in July, downgraded to the lowest in the lower medium grade. The rating downgrade reflects Castellum's significant exposure to more challenging capital markets conditions with increasing interest rates and widening credit spreads. About half of the company's interest rate is either maturing in the coming 12 months or based on floating rates, and we expect materially higher interest costs to drive a weakening of the group's fixed charge coverage ratio over the next 12 to 18 months to below 3.5 times. So, this downgrade has recently happened. It took already everything into consideration. In my opinion, it has done already its harm also to the share price, because we could see the share price falling quickly afterwards. And honestly, I just bought this week some additional shares in Castellum at 128 Swedish crowns. If we look at Castellum, I'll show you the reason as well. So the company generally is very well managed, has a really long dividend growth track record of 24 years. Almost everything looks positive here except the debt situation. So I'm not as bearish, although I know what Moody's is telling me. I had my fair value in the past on around 220 Swedish crowns. I made my adjustments as well based on that. I adjusted it to 186, and for me it's still undervalued. I believe that the company is punished quite a lot for this downgrade and also for the interest rate worries. I've done a little bit more of assessment here, and honestly, I feel okay with this. It's still a relatively small part of my portfolio. We're talking here about a 3% in dividend income. I don't want it to be more than 4% of dividend income, so I might still buy a little bit, because if it does a dividend cut, and believe me, Castellum will not cut for the next few years entirely to zero, then still, I mean, it's not harming me too much in my dividend income portfolio. This is how I'm managing risk. This is how I'm looking at it. So guys, I hope you found this useful. I know it was a full-packed video, quite a lot around credit ratings and how I assess it and how I really look at my portfolio. I can tell you, after this analysis, I feel so much better. I know that I have probably approximately 20% of my portfolio that could be better positioned, that I wouldn't call high quality dividend growth stocks. Some of them are here on your screen right now. This is it. This is a fact. It's also a result of over the last few years operating in a low dividend income environment. But guys, I hope we will see a deeper recession. I treat it as a blessing to really start accumulating some of the more higher quality dividend growth stocks. Guys, if you like this video, spread the word, share it with your friends, hit the like button. See you next week.